Meine sehr geehrten Damen und
Ladies and
Herren, einen
gentlemen,
recht schönen guten Morgen.
good morning and welcome to Wolfsburg. Welcome at Volkswagen. Thank you very much for joining us and coming all this way. With you, I welcome the head of the Volkswagen brand. I'd like to present these gentlemen to you in the first row. Let's start on the outside. It's Frank Welsch, member of the Board for Research and Development. Beside him, we have Thomas Ulbrich for production, Jürgen Starkmann for sales and marketing, Thomas Schmall for component division, Ralf Brandstetter for procurement, Karl-Heinz Blessing for human resources and personnel, Arno Antlist, finance, CFO, and the chairman of the board, Herbert Diess. This morning we've prepared some presentations for you. Mr. Diess and Mr. Antlitz are going to speak, and then we'll have ample time to take your questions. And on that note, let me give the floor to Dr. Diess. Dr. Diess, the floor is yours.
Thank you, Mr. von Westenbostel. Ladies and gentlemen, I would like to bid you a very warm welcome to Wolfsburg for the first Volkswagen brand annual media conference. You rightly attach great importance to the Volkswagen brand. We are responsible in the group for all vehicles with a transverse engine installed in the front, in particular the modular transverse system. And around 80% of group vehicles are based on this technology. Skoda produces about 1.1 million of these vehicles, Seat 400,000, and Audi too produces some 400,000 of these. And in particular, our joint ventures in China, with some 3 million vehicles, they all build their business on the technical and business architecture developed by Volkswagen. And in addition to this, we have some 200,000 large SUVs that the Volkswagen plant in Bratislava produces for Audi and Porsche. One half of the production, more or less, from the Volkswagen Components division is for other group brands, and in the future, the majority of electric vehicles from Seat, Skoda, and Audi will be based on the electric architecture that we developed. The Volkswagen brand is the supporting pillar of the entire group, and therefore, I believe it is in the interest of transparency from now on to inform you in greater detail and more frequently about Volkswagen's progress. Ladies and gentlemen, 2016 was a crucial year for the Volkswagen brand. It was a year of transformation that also was the start of a new phase for our company. We devoted a great deal of energy to the diesel crisis. We initiated the transformation of our business operations, and we prepared the strategic realignment of the brand. Many of you were here already 6 months ago when we presented our Transform 2025 Plus strategy and our Pact for the Future. Our mission in these endeavors is to strengthen the competitiveness of the Volkswagen brand for the future. By 2025, our objective is to play a leading role in the new and transformed automotive industry, to provide innovative mobility solutions, and to be the global market leader in electromobility. It is, of course, still too early to do a midterm review of our strategy. However, the first quarter is a good opportunity for us to review whether we are heading in the right direction. And it's a good time to provide you with an overview of our steps to come in 2017. First of all, I would like to touch on the retrofitting of our diesel vehicles. We are progressing as planned with this. In Europe, more than half of the vehicles have already received the necessary software update. In Germany, this figure is actually some 2/3, which means that 2.6 million vehicles have been retrofit. And our customers are satisfied with the retrofit. On average, only well, less than 1% of customers have notified of us of the fact that they're not satisfied, and we're normally able to rectify these issues quickly. Our 3,000 dealers played a major role in this positive outcome as they handled the recall swiftly and reliably. I'd like to take this opportunity to thank them very much for their support. Our goal is that by the end of the year, we want all Volkswagen brand vehicles in Europe to be fixed. And we also intend to complete the retrofit in North America and other regions of the world as soon as possible. And we're therefore confident that these tasks will have been handled in the foreseeable future. However, we're also aware that it will take a lot of effort to make the Volkswagen brand shine again. Ladies and gentlemen, we have invested a great deal of energy and attention in solving the diesel crisis, but at the same time, we've continued to make significant progress in our strategic and operational activities. Volkswagen has a sound foundation in development, in production, and in sales too. Our entire team is highly committed to driving the necessary change in the company. With Transform 2025 Plus, we've established our milestone plan for the next 10 years. The strategic realignment will take place in 3 major phases or steps. Between now and 2020, we intend to first significantly improve profitability in our core business and to regain our position as a leading volume manufacturer. And for this, we're aiming for an operating return on sales of at least 4%. By 2025, we intend to take the lead on the car of the future, that is, in the fully connected, fully electric vehicle. Returns are expected to increase to 6%. And then from 2025 on, we're also going to focus on new mobility solutions and business models in order to contribute to the major transformation of our industry from a leading position. Our main focus in recent months has been on 5 key projects. First, the quick and determined implementation of our Pact for the Future. It is an essential component of our strategy and will decisively contribute to making Volkswagen profitable and in shape for the future. We and the Works Council both agree that we must significantly increase productivity and reduce costs at our sites in Germany, our plants in Germany, in order to return the Volkswagen brand to the path of success. And we've therefore agreed on ambitious targets and measures for all plants in Germany, and together we will now systematically implement this program. Our goal for 2017 is to increase productivity by 7.5%. For the components division and for vehicle production, we have specific action plans that have been agreed on with the Works Council for all of our sites. Key measures include improve launch readiness for new products and thus more efficient product launches and ramp-ups. And we've just demonstrated this with the Tiguan, increased plant capacity utilization and thereby reduced working times, such as at the Salzgitter engine plant, a reduction in indirect non-value-adding activities, and a significant reduction in the amount of reworking required by improving our processes. And we will roll out this program step by step at all production plants around the world. Most locations in Germany are on track after the first quarter. That being said, the locations with lower capacity utilization will have a hard time reaching the targets for 2017. And that's why for the coming year, we'll develop catch-up programs to close this gap. At the same time, we've already made decisions as part of our Pact for the Future that safeguard the future of our locations in Germany over the long term. Starting in 2018, a new model for a sister brand will be produced in Wolfsburg. The 4th model for our Emden plant is in the development phase, and in Salzgitter, recently, our Center of Excellence began its work. It's responsible for development, procurement and quality assurance of battery cells and modules. And pilot production is currently in the planning phase. Then, project number 2, that's the successful launch of our SUV initiative. We will significantly strengthen our presence in this segment. By 2020, we will expand our global model range from the original 2 to a full 19 SUVs. In recent months, we've introduced the 3 new SUVs, the Atlas, the Terramont, and the Tiguan Allspace. Our Tiguan illustrates just how important these vehicles are for volumes, results, and image. Since its product launch, there have already been more than 300,000 customer orders for the Tiguan that have come in. Europe is not the only place where we produce the Tiguan. It's also produced in Russia, China, and for the North American market, in Mexico. We've ramped up there already. This vehicle, the Tiguan, is increasingly becoming a strong global revenue driver for our brand. And we've also achieved major progress in our regions, which is the third major focus of our activities over recent months. Our substantial restructuring programs are starting to bear fruit. In North and South America, as well as in Russia, we've grown at an above-average pace in the first quarter and have thus gained market shares, too. In North America, we have reduced fixed costs and have achieved a significant boost in productivity. The Puebla plant, our most important plant in North America, boosted productivity last year by 12%. Deliveries to customers have increased by 3.8% and in the United States by a full 10%. Thus, within just 1.5 years, we have almost achieved pre-crisis levels, and this was done without diesel models, which have been completely withdrawn from the market in the United States. Then, South America. There we've done massive restructuring. Over the past years, the number of employees was reduced by some 7,000, and at the same time, our plants there have become much more productive. And now the market is picking up after years of weakness, and deliveries have increased by almost 13% during the first 3 months of this year. And then Russia, too. We've gone through a challenging restructuring process there. We've cut shifts, we've reduced the number of employees, and significantly reduced the amount of reworking required there. And in terms of deliveries, we've achieved a 12.8% increase, which is a turnaround for us. So, in all 3 regions, the bottom line is that we've achieved significant improvements in our results. And this shows that our turnaround programs are starting to bear fruit. In addition to that, in China, we've realigned our import business and are achieving positive sales and margins again there after the phase out of the Phaeton. The fourth field of activity is our organization. We are becoming faster, more agile, and more effective. Following the introduction of our model line organization, which independently manages vehicle projects now, the regions also assumed full responsibility at the beginning of the year. We're already experiencing the positive effects of this independence. The regions are making decisions more swiftly and are closer to the markets and customers. Current vehicle projects are being executed significantly more efficiently now. I believe the best example of this is the next generation of the Golf. The technology and the design are already fixed 2 months ahead of the originally planned date, and without a doubt, we've never been so far along this process in a vehicle project at such an early stage. And then the fifth project that is proceeding at a rapid pace is the Volkswagen electric initiative. Our new e-Golf is taking a major step forward now. A range of 300 kilometers ensures everyday usability and practicality, and that's completely sufficient for many customers. In addition to that, over the last few months, we have given some concrete insight into the future of electromobility and our brand with the ID Buzz, and the ID Cross. The ID family is based on a brand new electric architecture. With this architecture, we are establishing the technological and economic foundation for the majority of the future electric vehicles in the group. Ladies and gentlemen, in recent months, we've driven our strategy forward and are laying the foundation for a new Volkswagen. We're on the right track, as is indicated by the good results we achieved in the first quarter. Deliveries to customers were 1.4 million vehicles, which was slightly lower than the previous year, but this was due mainly to China. The end of subsidies and reticence on the part of buyers have had a negative impact on the overall market. In the rest of the world, we grew by 1.2% in the first quarter, and in China too, we are now growing again. For 2017 as a whole, we will be in positive figures at the end of the year, there too. And in financial terms too, we are doing well. Revenue was up to about 19 billion euros, and we generated an operating profit of about 870 million euros. Due to corporate structural changes, these figures are only comparable to the previous year's figures to a limited degree. And Dr. Antlitz will explain these changes to you, of course, and the figures themselves as well. What we can definitely say with certainty is that the brand has gotten off to a much better start this year than in 2015 and 2016. So our thanks go to the entire Volkswagen team for this. Dr. Antlitz, the floor is yours.
Right. The Volkswagen passenger cars brand set off to a strong first quarter in fiscal 2017. In the first 3 months, we posted a sales revenue of 19 billion euros, translating into an operating result of just under 900 million euros. These financials show clearly that we are indeed on the right track. You all would prefer a like-for-like comparison basis with the figures of the same quarter of last year, but these figures can be only compared to a limited extent, particularly when it comes to unit sales and sales revenue. We've got a new reporting structure, which I'll briefly explain now. The Volkswagen brand, in the old structure, this is a given, was responsible for its own core business, of course, the development, the building and the sales of vehicles of the Volkswagen brand. It goes without saying that this will remain so in the future. In addition to that, however, a substantial share of unit sales came from the sale of vehicles from the group brands. Sales revenue from multi-brand importers such as Audi, Seat or Skoda vehicles in countries such as the UK, France and India have been shown as part of the Volkswagen brand's business in the past. The activities of some group service companies were also presented with the brand's figures. This, for instance, concerns Volkswagen Group Logistics. These activities, however, are only to some extent related to the performance of our own brand. And it's for this reason that we have separated the relevant companies from the Volkswagen passenger cars brand. The corresponding revenue from January 1st, 2017 will be consolidated at group level. By showing the Volkswagen brand separately, it can focus on its core business. What does this restructuring mean for the key financials at Volkswagen passenger cars brand? In 2016, we reported revenues at 106 billion euros. 32 billion out of these came from the already non-brand related activities. Applying the new reporting structure, in 2016 we would have had 74 billion sales in that year, fiscal 2016. Realignment would have resulted in a contraction of the operating result as well, at 1.6 instead of 1.9 billion euros. At 2.1%, the operating return on sales would have been 0.3 percentage points above the figure reported. From fiscal 2017, we'll be reporting with this new structure. With these companies, we're surrendering a substantial part of our earnings to the group. In 2016, the seeded units posted almost €500 million in earnings. On the other hand, at other junctures, we'll be streamlining the cost allocation within the group. Volkswagen brand will only bear those costs that it is directly responsible for. In total, this adjustment for 2016 would have impacted the brand's result with approximately €300 million. The structural adjustments shown increases transparency, makes it possible to compare the financials better of this brand with our competitors, and it supports the management focus on the brand's core activities. Now, let's take a look at the business development in the first quarter. As mentioned earlier, we set off to a strong fiscal 2017 with a slightly improved sales situation as a basis. We were able to increase our sales revenue by approximately €2 billion. There were two main reasons for these. First, some markets recovered. We were able to increase and stabilize our sales in Western Europe and clearly increase them in Russia. In North and South America, we also posted a stronger result compared to the admittedly weaker prior year figures. Exchange rate effects provided tailwinds as well, and the availability of the Tiguan was particularly favorable. The new model was very well received and resulted in significant positive contributions to both sales and earnings. At this juncture, I'd like to recall that the sale of our joint ventures in China are not included in our unit sales figures and our sales revenue or operating result. These sales figures are consolidated at equity. The operating result, €870 million, were achieved. The weak prior year's quarter was still significantly impacted by the diesel issue. On the other hand, we recorded growth in terms of both volume and price mix effects. Reduced use of sales support also has a positive impact. We have an earnings hub from this block of €600 million. Exchange rate effects contributed a positive €160 million. Particularly the Russian ruble made a positive contribution. Product costs comparing the Q1 2017 to that of 2016 were reduced by around €130 million. Also for fixed costs, we were able to achieve further progress. By consistent cost discipline in the first quarter of 2017, we've been able to have the fixed costs almost on the very low previous year's level, despite the planned SUV offensive and despite tremendous upfront capex in our electric architecture and our digital ecosystem. When it comes to fixed costs, the first measures from the Future Pact also started to gain traction and bear fruit. The structural realignment, as described in the first quarter, had a negative impact of 70 million in our operating result. The operating result achieved of around about 870 million euros corresponds to an operating return on sales of 4.6%. For 2020, we see three main levers to improve our earnings. First, our product offensive will contribute with the margin-intensive SUV segment to win market share. Dr. Diess has focused on this in detail. The rollout of the modular transfers toolkit, the MQB platform, will help to further optimize our cost basis. With its combination of product substance and cost basis, the MQB system represents a clear competitive advantage, a USP. The second lever is the Future Pact, signed in November last year. It targets a significant increase in productivity, 25%, a sharp reduction of factory costs, disciplined investments, and a considerable reduction in terms of bureaucracy by 2020. Third, we're expecting the turnaround in key regions such as North and South America and Russia to providing a considerable boost in both sales revenue and operating result. In these regions, we've been able to see the first successes. As Mr. Dies presented in the US, South America and Russia, since the beginning of this year, we've returned to the growth path. A considerable part of the improvement on the year-on-year result over the previous year are down to these regional performance enhancements. We're expecting for these positive developments to continue throughout the year. In the US, with the Atlas and the Tiguan, we'll be launching 2 new vehicles in the high-growth SUV segment. This will enhance our market presence, while at the same time better utilizing our capacities in that region. In South America, since 2014, restructuring has been ongoing. Our capacities have been geared to the market situation. In this context, we've had to reduce our workforce in Brazil since 2012. At the end of this year, we'll be launching an additional product offensive based on our modular transverse toolkit, the MEQB system. In Russia, the foundation's been laid for a market period of recovery. We've reduced our fixed costs clearly, we've increased productivity, and now it appears that the Russian ruble is recovering from its all-time lows from last year. Add to this that in Russia, our locally made Tiguan is very popular in that market. These effects in the first quarter led to an operating profit in the Russian region. It is our clear objective to achieve the break-even level in all regions at the very latest by 2020. Now on to the outlook for the brand in 2017. At the outset, let me say, please don't raise your hopes too high for the whole year on the basis of the first quarter. At present, we anticipate that we'll be able to increase revenue by around 10% for the year as a whole. This outlook is focused on the 2016 adjusted figures. We expect an operating return on sales with the upper end of the communicated bandwidth of 2.25 to 3.5%. This means that we're on course to achieve our mid to long-term margin targets of at least 4% by 2020 and 6% by 2025. By 2025, we expect positive contributions from our product offensive, the Future Pact, and from the regions. However, we also foresee substantial financial burdens looming. The costs from implementing the increasingly strict worldwide CO2 legal stipulations and the exhaust emissions legislation will impact us. The transformation of the industry towards e-mobility and digitalization will require us to do considerable capex. These effects will be overcompensated, however, by the Future Pact. We'll consistently examine our earnings targets with a critical eye and raise them the moment we consider that we've achieved a sustainable development going forward. Until such time, we will concentrate on the implementation of the Future Pact and our Transform 2025 Plus strategy. And back to Mr. Dies.
Ladies and gentlemen, the first good quarter indicates we're on the right track, and this gives us a tailwind for the months to come. However, in 2017, we believe that there are still further substantial risks. The market environment continues to be difficult. In particular, the outlook for North and South America remains uncertain. Then, important markets such as the UK and Turkey have significant political risks. Foreign exchange rates are an additional risk factor and are remaining the case, and we're planning a number of launches that must all be implemented successfully, and we are still feeling the repercussions of the diesel crisis. So, the rest of the year cannot be taken for granted. It's now crucial that we stay the course that we've adopted with resolution and continue to handle the tasks at hand step by step. First and foremost, we must further strengthen our competitiveness. When I began, I already spoke about the progress made so far with our Pact for the Future, and we're planning to take further steps in the months to come. And we intend to increase productivity both in this year and next year by 7.5%. Then, in 2019 and 2020, we plan a further 5% increase. We will improve collaboration between development, purchasing, and production to improve our ramp-ups. The ramp-up, the launch of the Arteon has so far run smoothly, and we plan to do the same for the Polo, the T-Roc, and the other launches that we've planned for this year. And we will maintain strict cost discipline. Our goal for this year is to at least keep fixed costs stable. In North America, two key vehicles, the Atlas and the new Tiguan, are being launched in the core segments of the U.S. market. And starting in the second quarter, we anticipate positive effects on sales. And we're going to much better utilize capacity in the Chattanooga plant with the production of the Atlas, and we intend to make further progress on fixed costs and material costs. Between now and 2020, we'll introduce two new models to the market every year. Sedans follow in 2018 and two more SUVs in both 2019 and 2020, and we're also working on a sporty derivative of the Atlas with 5 seats. So all in all, we will significantly reduce losses this year in that region in North America, and we plan to reach the break-even point, as Dr. Anslis said, in 2020. In South America, we're going to be continuing to implement our restructuring program, and at the same time, we're rejuvenating and broadening our product portfolio. At the end, in the second half of the year, the Virtus and the Polo will be based on the local MQB A0 global platform, and it will mean that we're bringing cutting-edge technology at competitive prices to South America, and we're going to expand exports to other South American countries. So therefore, for the rest of the year, we expect sustained positive developments. In China, we are highly profitable. There, we must defend our market leadership and make the brand more appealing for the changes that we're facing. With the Terramont, the Tiguan long wheelbase, and the C-Trek, we have already introduced 3 new SUVs and crossovers in recent months. And between now and the end of 2018, 9 more new products will be launched, which includes another 3 SUVs. One focal point in China is locally produced new energy vehicles. This year, the Fidian plug-in hybrid will be launched, and next year, 2 pure electric vehicles will follow. Across all regions, we have kicked off the biggest product initiative ever in the history of Volkswagen. You can see here, once again, an overview of this. This year alone, more than 10 new models are being launched. 5 of these are vehicles without any predecessors. The Arteon and the Tiguan Allspace have already been launched in Europe, and in June we'll be introducing the new Polo, one of our most important models, and in the second half of the year we will be following with the T-Roc and the Touareg. Two more SUVs, therefore, will be launched. The T-Roc in particular will contribute to an increase in volumes and earnings. All in all, between now and the end of 2018, 7 new SUVs will be launched globally. All new models have one thing in common. Not only do they stand for top-notch quality and technical perfection, they're also becoming much more sporty, more dynamic, and more emotional. The objective of our product initiative is to stabilize and regain market share, to restore brand appeal and to reestablish confidence in the brand. Ladies and gentlemen, competitiveness and profitability are not an end in themselves. They're a basic prerequisite to financing the major trends for the future, above all, electric mobility and digitization. One of the major trends for the future is therefore the development of a digital system. Services and apps will become an important additional source of products for our customers. This ranges from infotainment features to vehicle updates and new mobility services and solutions. In addition to that, customers will communicate with Volkswagen directly around the clock. As a first step, this year we're launching the new generation of the CarNet, and we'll begin with the first mobility services. This includes a park app. In addition to that, Volkswagen customers will be able to soon have their vehicles retrofit to the system. As a result, by the end of the year, we aim to have some 2 million users on our platform. Then, with regard to the electric car, our long-term objective is and remains that by 2025 we want to be global market leader in electric mobility and sell about 1 million electric vehicles per year. In recent months, we have given you an outlook on our ID family. It will initially consist of 4 members, and starting in 2020, it will be launched. This year, we're defining the technical concept and the design for the 2 most important vehicles. And in addition to that, we are outsourcing key components and determining what production concept we'll have. The ID will be the first car that will be produced in our Zwickau plant. Compared to today's vehicles, it will be produced some 25% more efficient, which thus leads to additional significant improvements in productivity. Costs continue to be a key task here, and as you know, we have set ourselves a double challenge. On the one hand, we want the ID to be affordable and cost roughly the same as a comparable diesel vehicle now, and on the other hand, the entire electric fleet should be profitable from the word go. Ladies and gentlemen, so as you can see, Volkswagen is on the right track in making headway in realigning the brand. The year began well. The first year was a successful kickoff for a new season of soccer, football, so to speak. And after the first game, now we've got a host of games to come. We feel that we are in shape, but we know that there is some need for us to do some more training. Our plan for 2017 has been established, and despite substantial risks, we are confident that the positive development of the brand can be continued. Our demanding schedule can be adhered to and that we can achieve our financial targets. Thank you.
Thank you very much, Dr. Dies. Ladies and gentlemen, we will now take your questions. The microphone's coming. Please wait for the roving mics to reach you. They're on their way. Then we'll have the question in the second row, and you can begin if you like. Horst Schneider from HSBC. I have 3 questions. First, on the Q1 figures and the outlook for the overall year. Great Q1 figures, but you're also referring to the risks for the rest of the year. Your margin expectations are conservative, which I understand. However, when you increase revenue by 10% for the second half of the year, a 2-digit sales growth would be possible or even necessary. And against this backdrop, it's difficult to understand why the margin would be lower than in the first quarter. Can you please give us some color on this? What risks are you expecting, and to what extent in your guidance in terms of currency, product mix, and the other factors you mentioned? Likewise, you did mention the free cash flow of the brand. I'd be interested to learn if the VW brand is making a positive free cash contribution already. If not, when do you expect to? And the next question is a bit of a strategic question pertaining to market share gains. When it comes to electrification, you know, in your targets for 2020 and 2025, are you assuming that you will hold or even expand your global market share? And I'd be interested to learn how you assess your performance with relation to new competitors such as Tesla, who seem to be very strong in batteries and who are planning to build more than 1 million cars by 2020. And somebody will have to lose that market share. Dr. Antzlis, let's start with the financials, and then Dr. Dies on question 3. Mr. Schneider, on the outlook, we had a very good first quarter, also in terms of ROI. Compared to the previous year, it was rather weak. And when you look at the rest of the year, two topics are important to our mind. First, two issues are looming. There's a certain seasonal fluctuation in our business. When you look at the figures of the past years, we typically had good first and second quarters. The first half of the year is always stronger. Then the third quarter is impacted by the factory vacations in the German plants, and the third quarter is impacted by Christmas. And what also looms is the ramp-up costs, the launch costs. We are planning a product cavalcade, an offensive in 2017, as Dr. Dies has already described. And ramping up the production, launching a new car, entails tremendous cost. In the months after the ramp-up, we have two-digit millions for a major project. We have the Atlas, the Tiguan in the US, the T-Roc is starting at Auto Europa. Those are cars without predecessor models. In the second half of the year, we expect some impact from these launches, and we see some risks, or we cannot be quite sure that the positive effects from Q1 translate. For instance, the ruble is a tailwind. At 60-61, it's listed. Nobody can tell today whether it will remain there. And the economic development in Brazil as well. We're not absolutely confident about the market gaining traction again. But our results and margins will, of course, be continually reviewed, and as soon as a trend is confirmed and secured and sustainable, of course, we'll adjust the outlook. Rest assured of that. Free cash flow? Well, I believe it's clear that the free cash flow at the moment is impacted by the diesel payments. This cash outflow, this is not so much in the center of your question. If I exclude that, we still today are faced with a negative free cash flow. However, it is our clear objective on the trajectory towards 2020 to achieve the break-even and to generate positive cash flow in line with the margin target which we've published. On the market share, Dr. Dies, in some regions of the world, we've been extremely successful. In China, we are the market leader with 14% lead. The next two biggest are 6% and 7%, respectively. We have had tremendous effects contributed by the local brands through our joint venture. It is our declared objective to maintain this dominant market position in China. We've got the product portfolio, the SUV offensive, and we're well prepared to hold our market share in China. In Europe, we've got a similarly strong position. Likewise, the new models will offer new opportunities to recover some lost points in market share, which we've had to suffer these losses over the last 2 years, and will recapture these market share percentages and hold and expand the market share in Europe. In North America, we fell back to position 2. We had fallen back even further. We're recovering market share with a product offensive. Again, we have the ambition to become the market leader in the medium term in Latin America as well. In growth regions, the US and Russia, the situation is different. We're coming from a very low market share, and we have growth ambitions there. We are a volume car maker, and we intend in the long term in the US, we're talking about around about 10 years, we want to be a significant volume car maker. we want continuous market share growth. On your second question, Tesla. Indeed, in this new world of the automotive industry, the interconnected electrified cars are at the center. And of course, they are a competitor we take seriously. For us, Tesla, of course, comes from a very high-priced segment. However, they're moving down from this high-priced segment, and it is our clear ambition with our new architecture to stop Tesla there, to rein them in. We'll be in the price range below 30,000 euros or dollar with our products. Surely, with some models clearly above that in their model positioning, but we have a clear leadership ambition. The architecture we're building at the moment, also in purchasing, the contracts already placed, the things are ordered, and we will have leapfrogging cost advances. We'll get a leapfrogging advancement in ranges. Anything Tesla can do, we can surpass in some areas, not just in the premium segment, but also in the volume segment. So it's going to be a general development here. So we are confident that we'll be able to stop Tesla in growth towards these lower price segments. We're better placed and we have better scalability competencies. We have important strategic partners with our 2 joint ventures in China, where electrification is set to start, where very quickly we'll achieve economies of scale and large production figures. We've got a worldwide sourcing organization. So we are confident that in this new world we'll become the market leader.
Patrick Hummel, UBS.
Patrick Hummel, I have 3 questions. Question 1 is about EBIT bridge for the next 3 years. You said your starting point for 2017 was that you already expect an EBIT margin that's at the upper end of the corridor, that is 3.5%. Now, we have 3 major positive effects. On the one hand, the Pact for the Future. Number 2, your growth in the SUV portfolio, where you're closing some major gaps. And last but not least, the turnaround in the 3 markets you mentioned. Now, if we assume that these markets will, well, maybe give you $1 billion loss-making right now, that would be 100 basis points alone for the margin. So my question is this: is the negative red block that you showed there actually just that small? And if so, doesn't that mean that 4% return, that target is really not ambitious at all? And then the second question refers to your brand contribution on R&D and CapEx. Mr. Witte said that the objective for R&D and CapEx ratio is set to go from 7% down to 6% in the next 3 to 4 years. Now, I'd be interested in hearing about the contribution for the Volkswagen brand to this target. And then last but not least, your targets for 2025, your goals there for pure electric vehicles. We have read that the Volkswagen brand has an objective of at least 1 million electric vehicles by then. And China will account for a major portion of that. And now you're developing an entire ID family, and that will probably be focused in particular to start with on Western markets. So therefore, isn't it just lowballing? Isn't 1 million too low? Because otherwise the amount of expense for development of a product family like that wouldn't pay off. Dr. Adlitz, you will take the first 2 questions, and Dr. Diess, the question about electric vehicles. Well, I've got to say, with regard to what you just said, is that we're always reviewing our objectives, and that applies to our strategy objective too for 2020, and therefore from the 3 different effects we expect positive contributions. However, I already stated that in particular with regard to CO2 conformity of vehicle projects and new emissions, that there's going to be a lot of expenditure going into that. That's far above 1 billion. And we also have a lot of upfront expenditure to make in electric architecture. After 2020, of course, that will put us in a very good competitive position. However, you've got to realize that our conventional portfolio, our conventional power trains have got to be strengthened, and we've got to go into SUVs, and then at the same time, we've got to invest in electric mobility and in our digital ecosystem. And therefore, from today's point of view, we're really sticking to the 4% there. And then the Pact for the Future, too. That's designed to ensure that now, okay, we just concluded it, and the main contributions will be coming in 2018 and 19 and then 2020. And with the Pact for the Future, we want to compensate for all these expenditures. I'd like to underscore that because I believe in the discussion on margins in the entire industry this year, 2020, and then 2025, we'll see, or actually people are underestimating fleet targets. You know about these for Europe, 95 grams. For some competitors, it's lower with smaller vehicles. And we're far from achieving these fleet objectives. And if you just multiply it by the penalties, then that would give you a number that really would be the expenditure for achieving those targets. And there are competitors that are 20 or 30 grams away from us and from achieving it. So it'll go through the entire industry. In addition to that, you've got the additional expenditures for emissions testing of vehicles and type approval. Every year there are lots of innovations coming into engines. They've got to revised yearly for European and Chinese emissions legislation. So the amount of effort going into the emissions testing is going to go up dramatically. So 2019, 2020, for the industry, and of course for us too, those will be very exhausting years, and we've got to successfully maneuver through those difficulties. And if we do so, we'll be seeing advantages for the years up to 2025. We believe we're well positioned for this, and our Pact for the Future really focuses in particular on those years, 2019, 2020. By then, we want to put 3 billion into German plants, that is proven from them in profit contribution. But we've got to have that in order to achieve our fleet targets and emissions targets. So it's a tough target. I understand that you're saying, okay, the 4%, well, maybe you're not euphoric about them, but I do think that they are a tough objective heading toward 2019, 2020. Maybe before that, it might be possible to be better than that for a quarter or so, but we have to realize where we're going over the long term, really. That's got to be what guides us. Then CapEx, development costs, 4.5% about. We're on the right track there in terms of all the work we're doing. So I'm seeing major increases in efficiency and development. I think we are going to be able to achieve group targets. Yes, that was part of our Pact for the Future, discipline in investments, and of course increases in efficiency in the development division. And we expect to have revenue growth that's a little bit higher, and therefore the relative share will improve. Dr. Dies, last question about the development of electric vehicles? The expenditures. Oh, sorry, yeah, I forgot that. The vehicles that we've presented, and incidentally, yesterday in the group, we approved the initial design for this vehicle, so we're on the right track. You're right, the idea is mostly a European vehicle, a hatch, but the first SUV that we presented in Shanghai a few weeks ago is indeed the most important vehicle for China, but that vehicle will also be sold in Europe and the US. We are seeing a global trend toward SUVs of the size of the Tiguan. And today we're already seeing there's a new principle that's developing. It's this vehicle segment with electric vehicles. Think of the studies that have been, concept cars that have been produced shown in Europe and in China too. And well, for the first product wave, we'll be offering 2 SUVs. One will be about the size of today's normal Tiguan. Another one will be a 7-seater. It'll be about the size of the long wheelbase Tiguan. And this is a core segment. And if you look at the Tiguan, you see that this really is a main volume segment. It's becoming that around the world. In particular in China there, more than 60% of our electric vehicle sales will be achieved with the same vehicles or slightly adapted vehicles. We'll do that in the US and Europe. And in Europe, of course, you've got the ID on top of that. It's the core of the brand, so to speak. A long term successor to the Golf. And the next question is from Mr. Mertens and then Mr. Hapke.
Can I just come back to the question on the CO2 emission values that you mentioned? How does it all fit together? By 2020, you want to launch 20 new SUV models, all in all. That surely won't make your life easier there. And to come back to the diesel, if I may, that you're holding on to. We are seeing diesel driving bans. The Federal Environmental Office in Germany has said that the NOx emissions are too high, even the most modern diesels. So life won't become easier. And I'd be interested to learn how you want to manage drivers of an EU5 diesel being affected by these driving bans in these driving zones. People are demanding a retrofitting by the manufacturers for legacy cars. How are you going to manage that? And how do you want to support the climate protection targets, which are meant to be achieved by 2020? Dr. Dies? Well, on the first question, SUV models. Naturally, we're not just talking about major size SUVs like the Atlas with 6-cylinder big engines, but also in the compact segments, we're talking SUVs. For instance, in the size of the Golf, which is very important for us this year, but also in the SUV and crossover model variants. These are in high demand, and they are experiencing strong growth as a category, and in their consumption figures, we are trying to get them close to the hatchbacks and the normal cars. So there is no major difference. Of course, they're a little heavier. But in the old markets, we see growth in the segments. Cars are becoming bigger, but the engines are becoming more efficient as well. And to our mind, we are therefore placed very well. We're positioned well with the right mix between electric drive cars and cars that the market is demanding with high contribution margins from SUVs to the bigger cars, which will help us over this emissions hurdle in the product mix. So looking at everything, we'll be able to balance the results with the right mix between electric cars and those cars that the customers demand in the markets. That's the right formulas. It will be very difficult with the traditional approach to just use small cars to compensate for the SUVs, because small cars are very difficult at high expenditure to get around under that fleet limit of 95 grams emission. So small cars will make no contribution or very little contribution towards achieving the fleet targets. So the electric car and SUV mix is the right way to go forward. The diesels will remain relevant to our mind. Customers love the diesels. And I believe it is increasingly supported politically as well. It is inconceivable to do without diesels in the European region. In the A segment, diesels, small cars, the diesel with EU6 compliance with the new exhaust emissions treatment system is a clean car. From the emission side, it is much better than the last generation of diesels, so it can be promoted from an environmental side as well. And customers, of course, you know, with customers it's extremely popular. And it's also very important to see that we meet the CO2 emissions targets in this class of cars as well. So for the diesel worldwide in some regions only, particularly in Europe, we see a great future for these cars with the modern diesels. Surely we will see in the smaller segments that the diesel cars will be replaced by smaller petrol engines or mild hybrid cars even, that we are developing, of course. But we remain committed to diesels, and our diesels over the past few weeks and the international comparison tests, they have had outstandingly good results, being among the cleanest diesels that you have worldwide. And with the support we are feeling now from politics and from the customers, there are good reasons not to abandon the diesels. The driving bans? Well, the driving bans, from my point of view, of course, our world is subject to regulation, and with the new diesel, we feel there are no reasons at all for that sort of thing. You know that the industry is working on further improving existing diesels. Different concepts are being weighed by their merits, and we know that this is not the only, the diesels aren't the only contributors to emissions in our inner cities, of course. And we know that with the new diesels, there are no reasons at all to ban them from the inner cities. The next question goes to Mr. Hapke, and then close to him, Mr. Ulrich.
Another three questions. First of all, about the Pact for the Future. It's about employment there. So can you tell us about your employment figures in those areas covered by the Pact for the Future? How they've developed between the end of 2016 and the end of the first quarter 2017? And then you mentioned the fact that, well, how could I put it? There's been a bit of a shakeout with the numbers. The Volkswagen brand doesn't have so much of impact on its return on sales from things it does for other brands. So has this consolidation been completed, or, well, how should we put it? Are there any injustices still that are negatively impacting the return on sales for the Volkswagen brand? Has that work been completed, or is there any left to be done? And then you talked about weaker sites at which there are some measures for catching up. What plant sites are those, and what catching up measures are those? I think Dr. Blessing can begin with the first question. The main impact of the Pact for the Future on our employment situation will be felt later, of course. Right now, we've focused on agency temps. We're reducing those numbers. And for the first quarter, in particular in Wolfsburg, we can say that this plant, and then Brunswick too, has been affected. There are about 400 agency temporary work positions have been reduced. We've got a total of 4.5. And by the end of 2017, they'll be down to nearly zero. However, not by doing everything in 2017 and outsourcing these things. Rather, some of these people will be given temporary contracts because they need them for a while. We can't do these things in such short term, but our objective is to ensure that we reduce the number of agency temps as far as possible. That's priority number one. Priority number two, that is phased retirement. Now, you know that phased retirement contracts have a certain duration, and by 2020, we want to have 9,200 phased retirement contracts signed as part of the activities up to 2020. And so far, 7,000 of them have already been signed. So we're missing just over 2,000 from a volume of 6,000. Then we're going to succeed in doing that. Our objective there is to achieve 90% of what has to be done by the end of 2017. Now, for those phase contracts, if I remember rightly, by the end of the year, 1,700 people will actually go into the passive phase. So we're on the right track there in that regard. However, there are differences between our different sites, in particular in the components division. There they have some sites that have great capacity utilization. They're not impacted by this at all. On the contrary, they have great demand, for instance, Kassel, for the transmissions, the gearboxes. And then there are other sites where the transformation is already going on dramatically, such as Brunswick. There, we're already reducing the workforce dramatically. We've eliminated most agency temps, and we're in the process now of transferring some of these agency temps to other sites. The numbers. I'll say something after that. Mr. Hapke, I did not say, or maybe I didn't say it correctly, I didn't say weak plants. I said plants with weak capacity utilization. That's what I meant. Of course, recently I was with Mr. Blessing, and we were in the Emden plant, and we were actually thrilled by the number of measures that they've developed, the tangible improvements in the factory, the reduction in reworking, and the agreement between the plant management and the Works Council, let me say that here, and the high commitment to achieving the productivity targets next year. However, the general conditions are very difficult this year because there's a launch going on, a ramp up, and they had supply issues there with the Passat 2 that were known to the general public. And of course, under these conditions and circumstances, the factory is not on target for achieving the 7.5% productivity increase this year. Due to this and some other reasons, because of the transferring of workforce members to other plants and so on. Nevertheless, we can say that we're quite confident that Emden will actually achieve these productivity improvements. They have got it kind of wrapped up, but due to the capacity utilization situation, it won't be in the next couple of months, it'll be by the end of the year, and then definitely next year we will be ramping up vehicles, which will help out. That's what I meant. Now, what's important in this statement is that we are not giving up with 7.5% productivity increase. We're going to catch up by next year because we've already got the measures defined. The third question was about the brand and how we are going to restructure brand and group, and by handing things over to the group, that means financial things will be sent to the group, and there's been a bit of a transfer this year, about 500 million euros compared to the last year. But however, with the new cost allocation in the group, the expenses go down by 200 million euros. And so that's appropriate from our point of view for our new structure for the brand, and it really is quite appropriate. So that means this process has been completed, and this has been done in complete agreement between the group and the brand. Mr. Ulrich, the next question is yours, and then Mr. Raab.
Ulrich, Freie Presse, Chemnitz. I have two short questions. First, which investment capex do you expect for the production of the first ID car in Zwickau plant? Second question, in Dresden, the e-Golf has been produced for a short while. What are the repercussions of the ID production on the production in the glass factory in Dresden? Mr. Ulrich would start answering the capex investment question in the plants. Yes, we expect that with the first car we launch, will be at 300 million production investment. And independent of this, you're asking about the glass factory. You know that we've successfully relaunched the e-Golf, relaunched Dresden, made it part of our production network, and the capability that Dresden has for electric vehicles will be used in conjunction with the Zwickau plant, and they'll be made part of the ramp-up and SOP, so that Dresden will have a role which has not been specified in the ramp-up in Dresden yet, because the two plants cooperate exceedingly well and have a very good exchange, and I can imagine that Dresden, with its acquired know-how, particularly for the first cars and in the first period, will make an important contribution. And the question on the influence of the ID on the e-Golf production, Messrs. Stackman and Dies can agree who wants to answer that. Well, says Mr. Dies, yesterday we saw the designs and the engineering for both cars. We adopted that and we saw them jointly. Mr. Verge had prepared that. And I found it very impressive as an event because it showed how these two cars are so extremely modern and futuristic even, and the next product life cycle, they will remain the most important cars with a long distance to the next contender. The Golf will be just as successful as the ID, while the ID will focus on a different clientele that will focus more on pure electric cars in other countries as well. So I don't expect too much cannibalizing between the two models, and the two production plants will be synchronized from spring, so that growth of the ID maybe to the detriment of the Golf, can be compensated for in this turntable production system which we have between the German plants. Nevertheless, the electric cars will be more productivity advancements, so the need of headcount will be lower for the electric cars, despite the great success of electric cars. Now Mr. Raab and then Mr. Kropp after him. Well, good morning. Michael Raab from Kepler Cheuvreux. I have three short questions, if I may. First, on the MQB A0. Can you briefly give us a feeling for what the technical commonality with the basic MQB is and the reasons why you have local modifications? Then, Dr. D, second, on the 25% productivity increase by 2020, to my mind, part of this is due to the reduction in headcount that you're planning. Can you give us some examples for what will be added to that in the manufacturing process as well? And the next question, can you maybe address further opportunities of the vertical integration? Can you give us some examples and some color on this? The first question, maybe Dr. Welch would be the suitable person to answer that. Well, the question is commonalities between the MQB or common parts between the MQB version that's in the market, that's familiar to us today, and the MQB A0. And second, why do we have a market-specific variant to this as well? The common parts across the MQB fleet, which is very wide-ranging from the common Polo right up to the Atlas and Terramon you've seen, everything follows the same technological principles, the assembly sequences, the assembly interfaces, the modules, and their interfaces, etc. The same applies to the Terramon and Atlas. We've expanded that upwards. Load bearing of axles, aircon systems for huge interior cabin spaces. From AQ0, we've moved this downward, smaller interiors, smaller cabin spaces, lighter cars with smaller axles, with not so much load-bearing capacity, but the same principles, the same assembly sequence, the same technical designs and specs. They're designed to be thinner and smaller, with the same principles, of course, resulting in lower costs, which are then in line with the class. The strengths which you know from MQB A0, of course, you will find that in MQB A0 as well. And by the way, let me mention in passing that going forward, some things, of course, can be done better in the next technical iteration. Second question, why is there a global variant? Well, if we have regionalization, if we take that seriously, then, of course, by market, we need to be competitive. Now, the regions vary. Of course, India is different from Russia and China again, with different specifications and requirements locally from these you know here. That's normal. That's not new, really. For large volumes, we make specific platforms geared to the local content need, local solutions as well, so that they get the global addition to their name. Productivity question goes to Mr. Ulrich. Well, on productivity, naturally, you're right. There are links between the development of our headcount across the demographic development over the years. That is what drives the promise in the Pact for the Future, the Zukunftspakt. Together with the Works Councillors, we have really gotten together and designed the development of our headcount and employee structure, improving competitiveness, of course, and focusing on the content of your question. Short term, of course, that will concern the conventional productivity things, the normal optimization in our assembly, in production, etc., that we usually do. And exceeding that, what we are driving forward as a brand, Volkswagen, in the product world. We are reducing the number of variants. We see great potential here, great leverage here. We've been able to leverage tremendous successes over the last 12 to 18 months, and also preparing the next product generations across departments and between production and development. We've been able to leverage synergies, successor cars on the MQB, the Golf 8, for instance, and the MEB platform cars that are coming for production needs exerting a different order of magnitude of influence, and together with the development engineers, we're realizing that, and that will be the basis. Mr. Schmal, on vertical integration, could you comment on that, please? Well, that concerns the value chain within the component manufacturing division. The challenges of e-mobility are tremendous for production. We therefore agree that we need a brand-independent transformation process. We've launched a group initiative on this last year. In this conjunction, we have coined the principles of operative manufacturing, vehicle assembly and component manufacturing. We've had a new structure. We've focused the focus areas to control this across brands. The internal combustion technology needs to be translated into a controlled transformation process towards e-mobility. Value creation portfolios have been considered, so products which are still making economical sense but which won't make a contribution in the future, we need to be able to let them go across all manufacturing locations from Kassel, Salzgitter, Brunswick and Hanover, to mention just a few of the main ones where we need to let go certain products and where we're transforming the production capacities. Salzgitter, for instance, liberating production, stator production for e-cars, e-engines, electric drives. So we're active at all locations to start this transformation process in the plants going forward to 2020 and 2025. Mr. Krog, the floor is yours, and after you, Mr. Schweiger.
Mr. Dies, I have a general question for you and then a special question. Within the framework of 2025 plus, you have very ambitious targets, one of them being, and this is a quote, the transformation of your industry. You want to help achieve that from a leading position. Now, what about the fuel cell in that context? Is a fuel cell a subject that you're still dealing with intensively? Is the fuel cell an option for powertrains that you personally and the Volkswagen Board of Management believe in? The special question is about the Mark 8 Golf. You said that in terms of its technology and its design, you are 2 months ahead of schedule. Does this also mean that the car will be launched 2 months earlier than we expected externally? Will it be sold to customers earlier? And could we imagine that maybe the car won't be launched mid-2019, maybe in the first quarter of 2019? And then questions for Mr. Schmal and Mr. Ulbrich, actually one for both of them. For pure electric vehicles, the vehicle weight is of major significance, dramatic significance. And for the ID vehicles, maybe carbon fiber reinforced plastics might be quite important. Is that the case? If so, Mr. Schmal, then what plant would make those components? In Osnabrück, you already have good experience with a very low volume production run. And then Mr. Ulbrich, high-strength steels and other especially lightweight metal materials will be used in ID vehicles. What proportion will they be, in particular with comparison to a car such as the Golf? And then question for you, final question, the brand icon, the Beetle, at least in terms of the coupe version, that is with a fixed roof, it is going to be phased out for the German market. It's on an older platform, the PQ35, and unless I'm mistaken, the Scirocco won't have much of a future for the production in Palmela. So, do you have plans for a design icon such as the Beetle, a similar vehicle that is reminiscent of the Volkswagen Beetle, and you might put it on the MQB? And are there any ideas about having a successor to the Scirocco that's comparable, or two-door cars? Is that basically it? Are they a thing of the past? Thank you. Mr. Dies, maybe I'll begin with the fuel cell? I'll begin with the fuel cell. Yes. Fuel cell for you, and then Dr. Welsch afterward. I can handle the fuel cell, I think. We still believe that the fuel cell is highly relevant for mobility, in particular in a scenario with more and more renewable energy. So if we believe that we'll have excesses of energy on days with lots of sun, lots of wind, the question is, what are you going to do with it? How can you store energy? And therefore, over the long term, an obvious idea is to split the energy into hydrogen. And hydrogen then can be stored. Because if the energy is regenerative, then hydrogen is a very sustainable fuel for mobility. However, we believe that the speed of introduction, well, it'll take a while. You've got to have an infrastructure for that. Hydrogen today is mostly produced in chemicals factories, so that's not sustainable. So we do believe that this trend is a long-term trend, and therefore, in the group, and incidentally, we also believe that the introduction of fuel cell vehicles will have to be done from the top down, starting in the premium class, big vehicles, because the technology is quite voluminous, and initially it'll be very expensive too. So we therefore decided that fuel cell research and early development and prototype production of vehicles that'll be done in the next couple weeks and years will be concentrated at Audi. We are working on that. Our labs here do good work, but the lead role is being played by Audi. And incidentally, we of course are participating in the cost. Hydrogen, yes, but after electric vehicles. Mark 8 Golf earlier? Mark 8 Golf launch plan. Well, we've got to wait and see, of course. Being 2 months ahead of schedule, that sounds good compared to our normal launch scenarios, but we're not going to decide on that today. And then lightweight materials in electric vehicles. Dr. Welsh. That was actually 2 questions. Number 1, what's the impact of weight? You said, okay, those things are heavy. A battery can weigh half a ton. That's true. At the same time, we perhaps should do more in terms of lightweight materials. What about carbon fiber reinforced plastics and other materials like that? Now, we have to remember 2 things at the back of our minds. Is the increase in weight correct? Yes, it is. That's obvious. But the influence on the performance of a vehicle and on the efficiency isn't as great as for an internal combustion engine, because you have major opportunities for recuperating energy if you've got electric vehicles. So the stored kinetic, well, you get a lot of the kinetic energy back to store it because we use regenerative braking in those vehicles. That's the first thing. And then for driving itself, well, we benefit from the fact that electric vehicles have immense torque starting at basically 0 RPM. That's a fascination with electric vehicles. People feel it right away the first time. And a weight like that isn't the problem, therefore. And then look at the second aspect, the target for electric vehicles and producing them at the costs of diesel vehicles today. And so we're targeting the volume segment. And therefore, the answer is obvious. Carbon fiber reinforced plastic is still expensive, so we won't do it. And then secondly, you asked about high-strength steel and materials like that. Now, this is something that we've been doing for a very, very long time, and I believe very successfully. We at Volkswagen in particular. And everything we learned there and have been implemented there, well, this can be done whether it's an electric vehicle or whether it's an IC powertrain. So we have a major lead over some of our competitors. Think about hot formed materials. We produce these ourselves. There are processes that we know about very well. And every car that we produce a little bit better. We're going to continue that. And then, Dr. Welch, Beetle, Scirocco. Beetle and Scirocco, for me and for us, those vehicles are representatives of an emotional and appealing class of vehicles. Now, if you go back, well, it's not always just about having one car and continuing it from one generation to the next. We're going to continue to have beautiful and emotional vehicles, but it could be that they have different names. We're in the midst of that. I think we'll even have more than in the past. The Arteon, I think that looks quite emotional. And then the T-Roc, we've heard about that several times today. And of course, we just showed it to you under a veil there on the pictures, but that also is a beautiful car, very emotional. And then look at the MEB concept cars, the ID vehicles that we've shown so far, the ID Cross, the ID Buzz. Well, if you look at those, then I think emotional and attractive is something that we can definitely apply to those vehicles. So you can rest assured that we will not just focus on functional and objectively appealing cars. On the contrary, ladies and gentlemen, we've got just over half an hour now for a Q&A session. I've got a list of 8 more questions, so I would request that you perhaps don't give us a very long question, maybe 2 questions most, so that everyone here can have an opportunity to ask their questions. The next is for Mr. Schweiger.
After him, Mr. Hitzner. I have a question to Mr. Dies and Mr. Anslitz. First question, Mr. Dies. Can you please give us some color on the details of the model which is meant to be made in Wolfsburg from 2018? You've alluded to that. And what is the proportion of the VW brand in the earnings of the Chinese joint ventures? High, very high. Now, first on the Wolfsburg model, I don't want to disclose too much. It's a sister brand, and they should enjoy the privilege of announcing what they'll build. It's going to be a car which fits in very well. It is basically a Tiguan derivative, which was planned along as we designed the production in that plant. It will be an SUV, which will fit in with the emotional makeup of the brand with a different exterior and a different interior. On the China joint venture, very high. Very high, indeed. Very, very high. Well, at this juncture, let me mention it because it's very close to my heart. The Volkswagen brand sometimes is, well, seen with a critical eye, with a view to its earnings weakness. And when you look at the China business of the brand, you see that the sales is Volkswagen to a major part, and also in terms of earnings, we contribute a lot. And you can see that when you look at the structure there. It's a high contribution. 3 million cars are done by Volkswagen in China, 3.5 outside. And I can tell you that the China business of Volkswagen is surely among the most profitable automotive business cases worldwide. There are hardly any markets that have the sort of market presence and the margins we offer. And I'll probably leave it at that. Mr. Hinz, and then very briefly, please. Christian Hensner, Automotive News Europe. 2 things. On diesel first, can you tell us what the penetration rate of diesel's development is and has been for the crisis for the VW brand? You're building 6 million cars. I estimate around about a third of these at the most are diesels. So half will be sold in China, probably. And what earnings impact does the diesel decline have? Is that really just this CO2 carbon emissions issue, or are there negative aspects, if you sell fewer diesels on the earnings as well? And you've mentioned less than 1% of your customers are unhappy with the technical fixes. How can you possibly make those customers happy as well? Could you, theoretically speaking, buy back those cars? And very briefly on North America, your break-even target for 2020 has been stated. Can you give us more color on the assumptions that these scenarios are based on for the sales and the utilization of capacity in Chattanooga? And do these targets apply to the US as well? In particular, as I assume that Puebla will be working more profitably than Chattanooga. On the diesel share, Jürgen Stadtmann. Very briefly, please, very quickly. Well, diesel is an engine concept sold in Europe mainly. We have a sales mix share of just under 40%, declining 3% per year in industrialized countries. This hasn't started last year. The diesel share has been going back. 3% last year, this has not changed. In some markets, surprisingly up, like markets such as Austria, selling more diesels in our product mix than ever before. What we do see is that the diesel discussion over the past months, which is nothing to do with us, really, in the region where this was pushed forward, buyers are insecure, but it's stable, in slight decline, as we've been seeing over the past few years. On the impact on our earnings from the diesel issue, well, as I've explained, the diesel will become clearly more expensive because of the new emissions laws and exhaust emission legislation, and that will be a burden on our business. We don't know the extent of that exactly, but there will be a considerable burden. Mr. Dies, well, the impact, if there is a change in the mix structure, that would be further savings towards achieving the fleet targets. You see minor variations in the sales. We are not seeing that because worldwide, as Mr. Stackmann pointed out, that the diesel doesn't have the significance worldwide. In the US, it plays no more role. But with a view to China and other markets, we'll have to see whether we see a trend towards petrol engines. Surely diesels will become more expensive. And part of that cost increase will have to be handed on to our customers. If we achieve that, then diesels have a similar margin to petrol engines, just like today, which we see today even. And the changeover of the vehicles, there will be technical fixes. How do you handle the customers? Well, the 1% unhappy customers, many of them can be satisfied very quickly. Something was done wrong. Maybe they weren't treated the way they expected to be. A couple of technical things have been corrected already, so that after slight correction and slight rework, the rate is just under 1%, and we don't feel at that point that we need to do much more. The customers are treated very well by the dealerships. The dealers are looking forward to getting the customers in because those are customers which haven't seen a dealership for a long time, so customer contact is re-established in these visits, and the customers are treated very well by the dealerships, and they leave the dealerships with stronger trust in the brand, so we don't see any need there. Then there was a question in North America and the break-even by 2020. That statement refers to the most important individual market in North America, the US. That's our clear target there. And that, of course, is corroborated by the SUV cavalcade or offensive. When the new Atlas comes, we assume that the volumes will rise. In the more profitable segments than today, the sedan, that's the first leverage, and the second is the rising volume will help to balance out the fixed costs better. And the third leverage would be cost improvements, productivity improvements in Chattanooga. We will have better utilization of capacity with 2 car projects, and the 3 effects will lead by 2020 to a break-even in the individual market in the US as well. May I ask you for your question, and then Mr. Rauwald.
Kurz, NDR. 2 questions. First of all, it's about the sales figures in Europe, in particular in Germany. Now, when I look at these, I imagine you can't really be that satisfied with them. So you said, okay, new models, you'll be launching new models, apparently one of the, and so apparently, well, we'll have them in Europe. Will that be sufficient in Europe and in Germany in particular in order to improve the situation? Question 2, it's about dissatisfied customers, diesel customers. There's some litigation that's already starting, unpleasant subject. I know they've already been appealed, the court decisions, the initial ones. So what risks you see, what costs have you calculated for? And maybe people might have a certain impression, is this correct? That is for litigation, it looks a little bit difficult and delicate. Are you going to settle out of court? Are you trying to do that? Mr. Stackmann, Europe and Germany. Yes, I'll tell you about our estimation of sales in Europe, where we ended the year quite stably in the first quarter. We have a very special situation in Europe outside of Germany. I'll tell you about the situation there. Europe outside of Germany, growth. Regionally, things very different. Strong growth. Central Eastern Europe, strong growth in in the north. We're satisfied with the situation in general, but we do see there's a special situation in our home market of Germany. Volkswagen, all in all, is a subject that's been discussed a lot here, and this, of course, has impacted the image of the brand, not necessarily positively last year. And in order to protect residual values, we have substantially reduced internal sales in order to take pressure out of the market. And we've got to say that this worked very well, the residual values for our brand. This is the biggest treasure that our customers appreciate. They're stable here in this market, and we do expect that our new products that'll be launched this year, starting with the Golf and the Arteon that'll be launched in the next couple of weeks, and then the new Polo, and then the T-Roc at the end of the year. We really do expect them to stimulate sales so that we're optimistic for our core region of Europe that will be able to end the year with growth. Next question can be answered relatively briefly. Legal risks. Litigation risks for the diesel issue, well, that's being covered and taken care of at the group level, and provisioning is done there too, so that's why I can't really say anything about that here. Mr. Rauwald, your question, and then Jan Schwarz. Mr. Rauwald, Bloomberg. I have a question to follow up on what you said, Dr. Welch, previously. As far as I understand it, Mr. Müller, at the group level, at the beginning of his term, announced that the product lineup was going to be reduced. And now you have been telling us about a lot of new models. Mr. Welch, when asked by Mr. Cook about the new Beetle and the Scirocco, that the new vehicles might have some different names. So could you perhaps quantify that? How extensive will the product lineup for the Volkswagen brand be in 2020? How many models will it have compared to this year? And then maybe another question on something you already said. Can you give us an update on the budget car plans you've got? Thank you. Dr. Dies, maybe you first? Yeah, let me give you some general statements about the product portfolio. We really have begun focusing our product portfolio to a great degree. You know about the Phaeton project, we gave up on that, and the EOS, that basically was eliminated without a successor recently, and the Golf convertible too has been phased out. We've got an ambitious plan for transferring our product lineup into the electric world. So a lot of the resources that have gone into niches and derivatives recently will be rededicated to high volume and hopefully high margin electric vehicles. And as a result, the overall portfolio for the brand will not grow because, at above average rate because of electric vehicles. Now, there's something we've got to say about emotional vehicles. We showed you the Buzz. There's a lot of ideas there, but of course, we've got to make sure that they make economic sense too. What's more important than the individual models, though, is that we have really succeeded in reducing complexity in product lines. For the Golf, 40% of the engine versions, powertrain versions, platform versions will decline that number substantially. We're clustering things, and also features that the market isn't demanding will be taken out too. So all in all, we will see a substantial reduction in complexity for the new model lineup. Incidentally, it'll be dramatic for electric vehicles, because there we will be reducing complexity of electric vehicles by nearly a factor of 10. A lot of different versions will be generated by software, and that can go right into the customer's cars. That'll lead to a major decline in complexity. So in terms of declining complexity, we're on the right track, and there will definitely be a couple of models that will be checked. The Scirocco will be one of those. The Beetle or the Beetle convertible will be among those vehicles that will be checked too. Then Jan Schwarz, go ahead, you're next.
Thank you. Jan Schwarz from Reuters. Two questions. To come back to your Pact for the Future, your Zukunftspakt, can you please give us a roadmap and some details for the savings? The 3.7 billion, how do you achieve that annual cost reduction? In the first quarter, you've mentioned costs that are linked to the programs. Do you have the savings figures already, which you could tell us? How many savings would be achieved in 2017 on the path to 2020? And I'd like to have a detailed breakdown of these figures. And the second thing is, when it comes to component manufacturing, this is meant to be under a virtual leadership structure. How far are you advanced along this trajectory? That is it. Thank you. Let's start with you, Dr. Antlitz. We've designed the Future Pact for the year 2020. After that, the sustainable savings will be 3.7 million euro per year. The target is 3 million in Germany and 300 million in the regions, and the main part will come in the years 2019 and 2020. The ATZ programs have been started and instigated, and the productivity increases are in line with the socially compatible reduction of headcount. So the main leverage will come from the Pact for the Future when the charges from CO2 and the emission standards, laws and legislation hit us. We've worked on the cost reductions, the efficiency program with a precursor program on the fixed costs. In 2016, 300 million euros reduction were achieved over the previous year. Same order of magnitude, even a little more, came from the regions. And this large fixed cost basis, of course, helps us in 2017. And in the combination of these good cost advances in 2016 and the effects from the Pact for the Future, the Zukunftspakt in 2018, 19 and 20, will help us to achieve our margin targets. Mr. Schmal, on the component manufacturing division. Well, thank you very much. On the component manufacturing division, I'd alluded to that we physically allocated the production plants to component manufacturing. We clustered the central functions and we're working with a trans-brand team to develop a control and leadership model. It sounds a bit theoretical. Virtual means nothing but that we want to form a group unit similar to commercial vehicles or passenger cars that will be part and parcel of Volkswagen AG that can act on an entrepreneurial manner in the operations for the component manufacturing. Now we have a question from Russia, and then we'll hear Mr. Denzel.
It's a question from Russian internet media Gazeta.ru. There were a lot of numbers about Russian market today, and can I ask you some maybe 3 short questions. One, you mentioned that you adjusted the numbers of employees in Russia, some costs in Russia. Could you be please more precise about this? Are you planning to reduce some workers this year or last year? And the second question is about negotiations between Volkswagen and Gazprom about producing cars on natural gas. What will we see about this? Maybe Mr. Müller was meeting Mr. Putin about this question also. And the last question is about export from Russian market, because now the demand in Russia is not so high, and the Russian government offers to find new markets to export from Russia some other markets. So what could it be, and are you interested really in this? Thank you so much.
Yeah. The first question was regarding the, oder auf Deutsch, ne?
The first question regarded the adaptation of structures to the local needs. I said in 2016, in transitioning from 2015 to 16, in Kaluga, we changed from 3 shifts to 2-shift production. The reason being the demand in the Russian market contracting. It's reduced. And we had efficiency gains in our overheads in Moscow. So that is concluded. The 2 shifts are fully utilized and they are producing productively. And we're not planning to reduce further headcount. Quite on the contrary, the Tiguan set off to a very good start with a positive feedback from the Russian market. It's very popular, so we see some upside potential rather than downside. On your second question, exports are always interesting for us, in Russia particularly against the backdrop of the Russian capacities not being fully used. We have an engine factory as well, which is not running at full capacity. At the moment, economic efficiency of exports, of course, are a very treacherous ground. It's very difficult, so we haven't been able to leverage major successes to be able to significantly export from Russia. But we're continually reviewing the situation. As soon as the conditions change, of course, we'd be willing and ready to export engines or even whole cars from Russia. Volkswagen Gazprom, well, that natural gas cars, there's a group initiative on this, reviewing the product portfolio and looking for alliances and cooperation options to make gas distribution more available. We've got a fairly close-knit network for natural gas only in Italy, where we have high market shares. We're the market leader with natural gas vehicles. And we've got our own filling station network in Germany, directly at the border, and there are complementary gas stations elsewhere complementing the system. We're trying to improve the manufacturing so that gas cars can be successful. We, as a Volkswagen brand, will make a contribution with the new Polo, which ramps up in the middle of the year. It will have a natural gas variant, particularly important for our Italian market. Where we have smaller cars, we'll make a contribution here. And on concrete negotiations with Gazprom, would have to ask at group level what the current status is. Mr. Denzel and then our colleague from Deutsche Bank.
Siegfried Denzel, News 38, Brunswick. Two questions. First one for Mr. Blessing. Mr. Blessing, a minute ago you were talking about the reduction of temporary workers in Wolfsburg and Brunswick, and Mr. Dies was talking about the reduced working time in Salzgitter. So could you tell us some numbers about the development of the workforce there? And then question two, it's more about local political aspects. Your sites in Wolfsburg, Brunswick, Salzgitter, they're suffering from the Volkswagen crisis. So what can you say to the town treasurers about when the millions of local taxes will be coming back in at the level of pre-crisis times? Or will it even ever happen? Dr. Blessing, could you begin? Well, developments vary widely. As I was saying previously here, it's mostly about the Wolfsburg plant. And up until the end of April, we had two different steps, and we reduced the agency temp number by about 400. But for the short term, we were able to send them to our commercial vehicles colleagues in Hanover, because right now they're setting up the T-Roc shift, and they have a need there. And of course, we also work to do our best for agency temps more than some other companies even take care of their core workforce. But at the end of the day, we do not have long-term employment for them. Then Brunswick. Up until the end of the year, we'll be reducing the number there to 0. Some have been given temporary contracts for a couple months. By the end of the year, though, we will be at a level of 0 in Brunswick for temporary agency workers. Salzgitter, it's not a major issue right now. Mr. Schmal, correct me if I'm wrong. We're not reducing agency temps there. And Kassel, it's not an issue there either. I actually pointed out that there's a need for employees there because there's a lot of demand for PQ 500 transmissions in particular. Then Emden. In Emden, we're reducing the number of temporary agency workers, but we always work among others or with other sites in the Volkswagen group, and if it's reasonable, we want to transfer people to other sites if there's a need there. Right now, we're in the midst of this process, and 300 agency temps are being transferred to Osnabrück because we have a demand there. But this often is an issue of how long they can last, and that depends on overall capacity utilization of Osnabrück and what it looks like for the future. So these are the things that are going on right now. You really have to distinguish between one site and the next. It varies widely. And also, we're always making an effort to employ these people, even if it's just for a couple months or up to 6 months. We want to transfer them to other sites if there's a need there before we hire outside agency temps at another site. We transfer people, as we're doing in Hanover now. Taxes, then, Dr. Antlitz. Taxes are paid by Volkswagen AG, so I hope you understand that I can't make any statement on that. But you saw when you looked at our quarterly figures that we at the brand, at least, are doing our utmost to make sure those taxes go up. So we're running out of time, ladies and gentlemen. So please, brief questions, brief answers. Next question for Deutsche Bank, and then they're back there, nearly at the back, and then Mr. Krüger. I'm way at the back here. Tim Bokos, Deutsche Bank. I have two questions on your margin targets for 2020 and 2025. If we look at the results up to 2020, well, at the very top it says the contribution is a major contribution from the Pact for the Future, and also growth and turnaround in North America. And turnaround in North America, of course, includes growth too, probably. Now, growth, well, for the Volkswagen brand, you've never had a lack of growth, but so you've always been good in selling cars, but the question is more about efficiency. And therefore, my question is this: how important is growth for improving the margins between now and 2020? Or to put it differently, will you be able to improve your margins if growth in North America, where the market is a little shaky, is not achieved the way you expect it to be achieved? And the second question, we've talked a lot and heard a lot about 2020, but 4% there, but 6% 2025, that looks quite impressive. So 4 to 6%, does that mean this development should be interpreted as being a decline in the need for investments for the overall industry because there will be less of an investment in IC engines, or is it about more profitability for electric vehicles, your ID models, which would be more of a volume question? Thank you. You talked about growth for the Volkswagen brand and how there was never a lack of that. Now, I have to explain something technical for 2 minutes. Now, sales to customers, that always includes China. And we grow dramatically for sales to customers. We at Volkswagen and the consolidated companies that I'm telling you about, that's without the local joint ventures in China. So that's just FBU to China, from here to China. And that's 50,000 vehicles, more or less. And the rest, well, that isn't shown in our books. That's just consolidated at equity. In 2012, among the consolidated companies that we report on, well, we haven't grown since then, and that was one of the reasons. Fixed costs have gone up, and we didn't grow here. And of course, we suffered from those higher fixed costs to a great extent. And now we've kicked off our SUV initiative, in particular SUV initiative in our product initiative, and this will help us turn this around. But with our Pact for the Future and the successor program, the efficiency program, and with our Pact for the Future, we've been able to take some major measures on costs, and with Pact for the Future, we've also integrated products. So this doesn't mean it's just focused on growth. It's based on a combination of growth in high margin segments and massive work on costs. And as I was saying previously, the fixed cost share in our Pact for the Future and in the efficiency program, well, they were achieved a lot earlier. They will be achieved early, 2017, and the productivity achievements in the Pact for the Future, that'll be in 2018, 2019. Let me repeat what I was saying, because I think it's an important finding, and it's something that's not really shared in the press. Since 2012, Volkswagen hasn't grown in our business outside of China. We've lost market share, and we've had to see declines in sales. And at the same time, fixed costs have gone up, which is one reason why the profitability was declining during that time period. Now, your question is also based on the idea of how important growth is for us. How important is it for us to grow? Well, let me tell you that on the basis of what Matthias Müller is doing and with his backing, we don't have any absolute sales targets for the brand or for the group. Rather, we focus a lot more on profitable growth. Nevertheless, I'd like to say here that for Volkswagen, it is important to achieve significant market shares. We are a high volume brand. We need the economies of scale in purchasing, in our plants. There we have to have capacity utilization in order to be profitable. Now, if we've got those factors, we can be very profitable. In China, we're very profitable. In Europe, too, where we do meet these criteria, and that's one reason why in the United States we are targeting strong growth, because in the United States we do not see a future as a niche brand, so it's important to grow there in the US, but it's got to be profitable. We're not going to fight for each and every unit and each and every market position. Mr. Krüger and then Mr. Menzel.
Earlier, you mentioned the modular transfers toolkit, making a major contribution towards improving the earnings situation. In the press, we read that it doesn't meet the expectations so much as you allude that. How's this contradiction explainable? What about the future in 2025? Do you want to be the market leader in e-mobility? With the new mobility, the illusion of what's in the pipeline, you described the parking spaces app. You'll probably need more to become the market leader. Can you elaborate on this, please? Yes, of course. On the MQB, from my point of view, we've talked too much too early about the MQB before it could really gain traction, because it was really before it was fully fledged. I was a bit critical with a view to the MQB. Of course, there might be a few things that we could have made even better. Maybe the variant range was a bit too wide, but all told, we'll have to say that the MQB is probably the most high-performance technological toolkit worldwide. It becomes most visible when you talk about the Skoda brand. It's really a European, sorry about the Skoda or ex-Skoda employees. It's really an Eastern European local brand with few economies of scale. However, the Skoda brand, proportionally speaking, is using it most. It is using it most, and Skoda is using in the volume segment a just under 10% revenue margin, earnings margin rather. And so it optimizes the cost base. It's all geared to this toolkit. And we see, when we're talking about the worldwide rollout, in China we have 35 or 45%. So this will increasingly have an impact on our market position and our margin position as well, increasingly. Particularly since on the material cost side, the purchasing cost side, we're making headway, establishing the MQB in the market and to source the MQB components even better in the market. Mr. Henning, you've got the next question, and Mr. Clausen, near to you. Stefan Menzel, Handelsblatt. One question on the monitor. This would be for Mr. Bies. The monitors here, what does that mean for the brand? Will there be major restructuring, homologation, and development, for instance? Things could happen and will happen. Mr. Dies. Well, the monitor's on board. Last weekend, he came for the first time with his team. There are ongoing talks about the organizational structure. By the way, I believe we're excellently prepared. We've built a team under Ms. Werner's leadership, Hiltrud Werner, and we've organized the areas of responsibility, which are organized together with the monitor. Many focus points consider the brand, particularly technical development. You are aware of the consent decree, and that we've agreed in that and committed on changes being introduced at Volkswagen. These are being planned with new allocations, new responsibilities in the development area. In the brand, we've named a project leader with the organizational team who, over the next 3 years, will collaborate with the monitor. This will concern all divisions. I see the monitor as a great opportunity, by the way, for Volkswagen to change and improve the processes at some points, to make clearer who's responsible and to become more lean and efficient. I've got 2 more names on my list. Unfortunately, we'll have to wrap up the large round of questions, but we can answer questions bilaterally after that. The next question goes to Mr. Clausen and then Mr. Bossen. He's up here. Mr. Clausen no longer wants to speak. Oh, yes, there you are. Clausen from Dow Jones. Short question on the VW plants in Germany and internationally. For your home country, you have made a blanket statement. Closing plants surely is not on the agenda. What about capacity? Particularly in China, with electromobility, you want to set off to a flying start. Are the capacities enough, or do you need new plants? The answer? Well, we have some reserves in capacity, so when we're planning growth, we can either expand the production plants or factories, or we have reserves, such as in the regions like US and Latin America. We have reserve capacity to map the growth to there. We expect the strongest growth there. Here in Germany, we are not considering new factories, but will change over existing factories to electric cars. And similar things will happen in China. We are the clear market leader at 14% market share. For the capacity will become productive over the next months and years, so that we're not planning with major new investments at the moment. And we can make full use of our network capacity. And William Boston, another question.
Mr. Dies, I wanted to touch on the subject of the MEB. In Germany, you're talking about building the first of these cars, but when it was mentioned the first time, what I understood, maybe I misunderstood it, was that in the future too, MEB factories will be built or will be necessary in China and in North America. So what about your plans for setting up this infrastructure in the United States? When do you want to build ID cars there? And maybe you could tell us a little bit more, please, on your outlook for the United States. We've seen that your sales figures in the market, or that sales figures in the market have started to decline there. So are you fearful? Because you want to start to grow in a market which apparently has gone past its peak. Let me answer the question on MEB factories first. MEB is designed so that basically it can be incorporated in existing factories. The mix of material, the body is a steel body. Of course, there'll be adaptations that will allow us to achieve productivity increases. Painting capacities, of course, can be used here in Europe, and then assembly lines too, partially. So step by step, we can move over to electric vehicles. We want to begin in Germany because here we're very close to technical development, and we need that in full knowledge of the fact that the leading market for electric mobility will probably be China in the years to come. And that's why in terms of vehicle development, well, we're going to be having a bit of an offset 6 to 9 months later in China, and the third phase will then be the United States. Which specific car and when exactly? Well, that'll be past 2020 in any case, but these things still have to be decided. Of course, we've got to ask about production sites and think best about where we can most easily incorporate those vehicles into production. The United States, you're right there. The market is at a very high level right now. However, we do have some catching up to do, pent-up demand. We've got an outstanding dealer network there. We've got a major product initiative that we're planning for the U.S., and I think it'll really be compelling. For the first time in core segments in the United States, we'll be offering great vehicles there, A SUVs, B SUVs, A and B sedans, and then with derivatives too in the core segment. So in the United States, in terms of our product portfolio, we'll be better positioned than ever before. And in addition to that, we'll be more and more competitive. Our factory in Chattanooga is going up to high capacity utilization. We're going to be able to better use our network of suppliers. We've got highly motivated dealers in the United States. I believe I can say that here. And they really believe that the brand can do a lot. And we believe that even if the U.S. market is stable, we have clear opportunities to gain market share and thus to achieve some positive momentum in the United States. So, even if the U.S. market is stable, we're confident that we can continue to grow there. Ladies and gentlemen, thank you very much for your questions. And at the same time, I hope you understand that we were not able to answer all of your questions here to the overall audience. But afterward, of course, you can have a bite to eat before you head home and maybe talk to some people. We hope you have a safe trip home. Have a nice day and then a nice weekend. Thank you for being with us today.